here's what I'm going to do. I'm going to take their current portfolio, I'm going to pick it up and I'm going to move it back, and I'm going to back test it through March 2020. This will be a good indicator of how their portfolio holds up through a crash. As the portfolio manager said, they were up money. Okay, let's talk about how I took the current Skyview portfolio and back tested it through the 2020 crash. So how did I do this? I have their current portfolio and I have their account size. I understand their trading method. They pick certain expiration cycles, which are the monthly cycles that expire every third Friday of the month. They enter positions consistently with X days until expiration. I don't want to say what days. That could be proprietary. Probably isn't, but I don't want to take a chance. They have 12 positions. 5 of them expire on September 18th. Today is September 1st, by the way. 5 of them expire September 18th, and 7 positions expire on October 16th. The last crash occurred in March of 2020, and I need to build the positions that expire in similar expirations, which would be March 20th, 2020, and April 17th of 2020. I'll build 5 positions that expire on March 20th, and I'll build 7 positions that expire on April 17th. So my positions will be held through the crash. I'll use the same stocks and the same options positions that are in the current portfolio right now. So, for example, I know the type of positions. For example, a short naked put, I will know the entry pricing. I know what the price is, the premium that was collected currently on their current portfolio. So, for example, if there's a position with a sold put on Apple for $2 for a $2 credit, then what I'm going to do is I'm going to find the same put, and of course in the correct expiration cycle with the correct amount of days until the position expires, and I'm going to find that same put that also sold for $2. And using this method, I was able to replicate their portfolio ahead of the crash. Okay, I'm using OptionNet Explorer here to go through and back test these positions. And this is trade number 1. This is when the position was put on. Let's go into the crash, see what happened. Did okay, up $36. Okay, so now I have trade number 2. Let's see what happens. This is the open. Let's go into the, okay, so here's the end of the day. Here's the crash. You can see that this position number 2 down 48.21. Here's trade number 3 at the open. Here's trade 3 in the crash, down $2,370. Okay, here's trade number 4 at the open. Here's trade number 4 at the crash, down $643. Here's trade number 5 at the open. And here's trade number 5 in the crash, down $1,276. Here's trade number 6 at the open. And here's trade number 6 in the crash, down $473. Here's trade number 7 at the open. And here's trade number 7 down during the crash, $1,131. Here's trade number 8 at the open. Here's trade number 8 down $1,246 during the crash. Here's trade number 9 at the open. Here's trade number 9 during the crash, down $751. Here's trade number 10 at the open. Here's trade number 10 in the crash, down $2,427. Here is trade number 11 at the open. Here's trade number 11, down $1,439 in the middle of the crash. Okay, on this spreadsheet, I have compiled the information of the back tests when I was able to pick up the portfolio and put it together before the crash in March of 2020. I did not divulge here in the spreadsheet the names of the stocks that were traded. I just called them trade 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So it looks like I had 5 stocks traded in this first expiration cycle, and then I had 6 stocks traded in this expiration cycle. Sorry, I think I put 7 in the PowerPoint there, but there's actually 6. 1, 2, 3, 4, 5, 6. Yeah. So on this, basically what happened, this is right here what their current position was. So for example, position number 1 was like a kind of like a broken winged butterfly. So, and they brought in $152, and their profit target typically is half of what they sell their premium for, sometimes a little less, but I just went with half. So they're trying to make $76 on this trade number 1. So when I put the trade together, I got $134, just a little bit less than the 152, and I'm trying to make $67. And going through the crash, I actually made $42. So this trade probably hadn't closed out yet, because when it hits $67, it would hit its profit target. Now, trade number 2, that one was just a short put. You can see they collected $200. I collect $223. That's as close as I could get to collecting $200. My profit target's $111. I lost $4,821 on that trade. So I'm trying to make $100, and I'm down almost $5,000. That's what happens in a crash when you are short puts and the volatility rises exponentially. Your losses rise exponentially. So right here, you had a 43x loss. In other words, you lost 43 times what you were trying to make. Trade number 3 was also a short put. And you can see the exponential losses here. Trade 4 was also a short put. You can see pretty good losses. Trade 5, also a short put. You can see that you're trying to make $60 and you lost $1,276. I mean, it's huge. And then this expiration cycle was a little more forgiving because it's further out, and there's a concept called weighted vega, and that's the reason why these guys weren't as punishing, these further out ones, than the closer in expiration cycle. But you can see the multiplier, this thing lost 4 times what it was trying to make. This lost 24 times the amount of money that it was trying to make, 16 times, 14 times. So if, for example, if you have a 16x loss, that means you've got to make profit 16 times in a row just to get back to break even. And look at the size of these multipliers. So on average, this portfolio, which was around $25,000, lost $16,500, down 68%. That 68% loss going through the crash with the current portfolio that they have, if the market crashes tomorrow or the next day, their current portfolio will be down around 70%. And that is pretty much in line with what was talked about in their losses earlier in the video that I was referencing. Well, as you can see, I back-tested their current portfolio through a market crash, and it was down close to 70%. This falls in line with the large drawdown that occurred in their real portfolio in March 2020. Oh wait, I forgot. They made money in March. Well, they either took out money or they lost money, and they still have not come close to recovering in that account. This concludes part 3 of my review of Skyview trading. Be sure to be on the lookout for part 4, the final part, when I talk about a margin call.